What was your question, by the way?
Because I thought that that peak that finished at 10.55 on a 1 minute chart was a wave 3. I was wondering whether there's any indications, given that it had the double kind of run down, whether how long the wave 4 would last. But you've said it's not really a wave 4.
Well, obviously there's going to be a wave 4 technically when you look at it. So when we look at the chart, the one that I'm looking at, you're seeing my M1 chart, right?
Yeah.
So we have a new peak here, and as soon as we have this first green bar, we have the minimum requirement for wave 4. So this is the wave 4. What I meant to say was that we would initially, the way price went back was a very strong reaction, and it went all the way back and it retested those levels. So obviously now technically this is a wave 4, but right now I'm not interested in it. It's because what I want from the London session is I want this initial break, which it did here. Then you want the pause, and then you want the other push again. So even if it's like the first push and the pause and then the second one, and if the second one turns into a 3, often people will then start looking for a wave 4, wave 5 again. But I don't usually go for that. I just call this like an extended, like in my mind I would say, oh, this is an extended wave 5, let's call it that. Because there is a finite amount of energy in the market, and that's when that's consumed, the market usually will start going sideways. So over here, I would have still looked for a wave 4 if had the price kind of got stuck here and then started going sideways. So what you need to see is
so you kind of only want a retracement of about 38 to 50% retracement.
The problem with this is that this was a very extended move. This is where the fruit mindset kicks in. Like when price moves too far, too fast away from the data, very strong peak, it will snap back, and that's exactly what it did. It snapped back. So if you go to the 15-second chart, see this bit here. This is that last gasp of air before before drowning, right? That's what it did. And this is where usually we look for longs, the fruit mindset. But you see price went straight up, targeted those levels, and as soon as it was above those levels and it crossed the zero line, now from the setup point of view, you would think, okay, this is a 3, now it's wave 4, probably set a pending order here. But that didn't even occur to me. I actually went long here, and here. Was it here? I actually went long here. That was a bit early. I'm not suggesting everybody should do that. I wasn't using this template. So if you're on this template, long here and here would be completely against the strategy, because you don't trade between price. When price is between this green line and this purple, that's the no trade zone. But if you went long here, it would still be okay, because you are still above everything, above the box, above the lines, above the purple and everything. And now we have kind of a setup 1 here long, but I wouldn't take this because I don't see the strength in wave 3 here. So that's for this time frame. But if we go to the M1 chart, we cannot say that that's 1, 2, 3 going on, or a sequence going on. So here another thought, another idea that I talk about all the time. So if we call this a setup 1, on this time frame it will be a setup 1, but we always look at where is my setup 1 within the 5 times higher time frame. Where would I put this in that trend or that wave, which is here. So now we are actually debating whether it is a wave 4 or whether it's a good wave 4, whether we should take it or not.
So on a 15-second chart, because it's crossed the purple line, doesn't that invalidate it as a wave 4 automatically anyway?
For the down move, yes.
Yeah.
For the down move. Like for the purpose of the setup one, as soon as this price went above, that's what I'm saying. If you went long here with the mindset that you're trading or trying to catch the reversal up, then that's fine. But at the same, and you're going long because at this time you have now considered it that the 3 and 4 is now null. On this time frame, this is now not your 3 and 4 up. So what is it? It's the wave 0 now. It's the wave where we don't know which wave it is.
Mm-hmm.
But if we focus on the current situation over here, up to this point, it was a 3 and a 4. So on this point, it was a 3 and a 4, and a 5 up was possible, but you wouldn't take it because when you look at the 1 minute chart, obviously we know that we are still thinking whether it's a 3 and a 4 in this. So obviously it's in wave 4 on M1.
Yeah.
For now, it's wave 4 because if this is 3, this is 4. So would you take a short here? That's another question. And the problem with that is that your wave 4 is very impulsive. It's kind of very strong up and it goes sideways. But more important than that is the day trading rules and stuff that we have. We want to trade closer to the London Open. We want to trade this. And this is my solid rule. If I'm able to catch this, and then I'll probably pay a rent or two in this, and then I would trade this. So if I've done this trading here and this here, I have to stop. That's job done. Because if we don't stop, there might be days where the market would move all day and all that, but that would happen like 3 or 4 times a year. So if you miss him, it's not a problem. But these things will happen 2 to 3 times a week. You just want it to happen once or twice a week. That's enough for you. The rest is, it depends on patience is important. And the market enters this box. I had my 10-year-old with me and the market was in this. He stood next to me and he was, let me go to 15-second chart. When the market was here, yeah, like so. So he kept looking at every move and he said, "Daddy, you're missing a lot of trades." And I said, "No, I'm not. Because it's going sideways. We want the market to break these levels." So, when the market did this and then it started going sideways, obviously I went short here, added on here. As soon as this candle was printed, I quickly exited. After that, I don't trade. Why? Because I applied the concept of I want clean breaks. So if this wasn't broken, then I will not trade until this is broken. So I can mark this level here. I'm not interested in this. I'm not. I want this to be broken. It wasn't broken. Now I'll bring the line here. Then I want this to be broken. I'm not interested in this. I'm not interested in this. And that helps me because look at it again. I didn't know this was going to happen, but I had an idea it might happen. It comes here, it bounces against it. Yes, sometimes I might find myself trade here and be aware of this level. And I would see, okay, I'm going to see the reaction. As soon as I see the reaction, price is going back up, I'll get out. Then I had this level. So when it went sideways and the time is passing It's not going down, but this is important. It's not going down, but it's not going up either. Which gives you an idea that if it's not going up, there are actually higher chances that it might resume in the direction of the previous trend, which allows you to take trades like this. So again, if you took here, you are taking a breakout within a range. It's risky. So you have to minimize your risk by going lower lot size. So if you were to go short here, this is your idea, this is your level that you have to look at. Anyway, I didn't go short there. I waited for it. This time, first it reacted, it went up, but then it closed lower, and then it closed below it. Over here, I was short, around this level, and here. And then after I marked this level, this was already marked, I said to myself, if it breaks this, we're in a free fall territory. If you remember in Discord, I put that line. Now we are in free fall territory because, and when it broke this level, it broke it with style. Can you see this? Just bang, it goes down. Then it pulls back up. This was your first perfect pullback entry. Here, here, retest it. You had to be patient to hold on. Sometimes this would get me out. Sometimes I would be short here. This would pull back, I'll be out because I won't believe in it or something like this, right? But then I'd get back in if it continues. And in this occasion, I was short here and here. It went down. Then took one more here. That crashed through quickly. And then after that, it was pretty obvious that now it's kind of taken their last gasp and it dropped quite a lot. And that's it. So it doesn't happen every day. But when it happens, you took this trade, right? You took the M1. So when I choose to trade the 15-second chart, then I wouldn't be taking setup ones on the M1 because then there's a confusion, like it doubles the risk, and so it's best to like stick with one thing. So for example, if you're trading the setup one on the M1, then that should be your thing. You should be just waiting for those and trading those. If you like what Dave did, hold on. So earlier, let's go back. So when we had the first attack here, so today it happened like 15 seconds before London Open. But I do look at these levels, right? If you remember, I put those lines in the chat room. I said, the levels are defined, price is in the box. So when that happens, I'm really happy because now the job is easy. All I have to do is like, right at the London Open, I want a clean breakout. But it happened a minute before. Okay, fine. That's even better. Because right at the London Open, I can go. But then, as soon as it broke out here a minute before, we have this pullback candle here. I think on the MT4 we had 2 candles pullback on the 12-second chart. So this was my first entry here. That's the first 20 points here. Went back in, another 20 points here. And that's usually enough. That's usually
12
enough.
seconds is a bit fast for my brain yet.
Yeah, well, it's not necessary. We should only trade the time frames that we can process the information and stuff. 12 second is fast. Not for setup one. Yeah. Not for setup one. We have to find that fast enough and slow enough for your brain to be able to process that information and take decisions.
So I was looking to do a breakout trade under that on an M1 low at London Open, but I didn't get my order in time, and then there was no other entries on an M1 to get in.
Yeah. Well, setup one first on the M1. Then you can, if you wanted, you can do the setup ones on the 12-second chart. which would not have been fun today, because obviously you would have been B-trapped over here. So if you're trading a setup on a 12-second chart, this is your trade over here.
Yeah.
And today it just didn't work out. Not for that. So if you were trading setup 1 and you are in stage 2 or 3 or something, then what you could do is to, when the wave 4 extend itself like this much, you know, we don't trade those wave 4s. So then you wait for price to actually break the lows of what you think is a wave 3, like this. So when it broke here, then you can take setup 2s. You know, setup 2s are just break of boxes.
Yep.
That can be done. Anyway, so I was saying, if you mix the two, you have to ensure that your lot size and your risk percentage is different for every type of entry. So with the pullback method, I go with fixed lot sizes based on fixed points, and that's appropriate for that time frame. So for 12-second chart, I think about 10 stop loss usually gives you double the space between price and, so like if I go short here, 80, stop loss is way up there. So that's pretty good. Sometimes I even go 15 when, you know, when it's even higher volatility. So then I would calculate, I've already calculated lot sizes based on 10, 15 and 20 for the week. That's what I do on Sunday. So this week, what's my lot size? I usually trade with the same account size because this is my strategy. I don't do compounding and stuff for the day trading. I just have a certain level of account, and when it grows by a certain percentage, that's taken off. That's also money management, money and risk management. So like if you don't take money away from your account, if you're profitable, then you are risking more and more of your money every week. Like people call it compounding and all that, but you have to, there's another way of thinking about it. The bigger your account, the more risk you're taking. So that's also a different thing. Anyway, so that has to be different. So for setup 1, you need to, when you go short on a setup 1, let's say if you are going short here, you have to know, you have to establish, so where on this chart is the peak of wave 4. At this time, the peak of wave 4 was this. So you will not be proven wrong until and unless this point is broken. So you should stay in that trade. So if I use the bar replay here, this is your first cross of zero line, and the box is formed. So this is very early entry because it's just crossed and the gator is sleeping, but you know, not entirely inside the box. So if you let go of this trade based on that, that's fine.
So I would have denarded that one because the bar wasn't past the red line. Like the box wasn't below, yeah.
A few candles later, it was correct. Was there enough distance between levels to the left? That was kind of okay. You know, that's why if you look at the 3 rules flow chart, we have the orange boxes, and that is where traders' discretion is required. You know, when we say, is the level to the left too close in the flow chart, we have colored those orange, and the reason they are orange is because, like, if they were not orange, then that means that flow chart could have been coded into a robot. If we did not have the orange bit in there, traders' discretion wasn't there, then that means that's it, code it, and it should work. But that's not the case. That's where you need the human intervention. Like, okay, you have to mentally look at that, make an assessment. Is the volatility and the momentum of the market correct today? Is it going nicely? Is there enough distance? So anyway, you will take this trade. Whoever took this trade, well done. It's a DS1. Why did it not work? Well, that's what it is. It doesn't work all the time, but it works more often than it doesn't. So it gives you about 66-70% win rate if you trade it. So even if you took this trade like this, you're on the winning side. So it goes, but what Dave did, I think he went in here and then got out. So what he made in this, he gave it back here. But I hope that he's recovered. I hate using the word recovered, but I think if you make a mistake here and here, and if he waited, he probably then made some more here. From day trading point of view, for longer term profitability, it's not only about see the setup, take the trade. It's about maintaining that balance on a daily basis. What is your target? Like in most cases, if you hit your 10, 20, 40 points in this and you don't trade the rest, that's good for you. That's good for you. Or if you miss this and then you came here and took a short here and then you tried it again here and you paid 2 rents, you have to stop. I know that if you didn't stop, if you stopped and then you saw this and missed it, you'd feel gutted, but that's fine. Why? Because if you don't stop here, then you would have taken this and this and this and all of that, and then you'd be down even more. And there's this mindset. Sorry?
Done that before.
Yeah. This mindset of, oh, I've lost and now I have to recover it. That shows that you are saying that I make money in the market at will. Well, if that was the case, if you could recover your losses by putting more energy from your side, that would be a great thing if it was true. It just doesn't work that way. You have to have a probabilistic mindset. Like if your setup failed twice and you've hit your daily stop loss and you stop, that will ensure that you are going to be profitable in the long run. Not by forcing trades on the market because, oh, I've lost 2%, now I have to quickly make 2% and 1% on top. Well, why didn't you do this to start with? Why didn't you come up with this mindset straight?
So, Imi, is there a methodology for working out what a reasonable daily target might be? Like, do you take that from your batches of 20, or do you?
Well, we should have a monthly target. So a 10% monthly target is achievable by trading 1 hour a day. 10% might look less to people who see other YouTubers, or they have their dreams and aspirations. They think, oh, it's not much, but actually it's quite a lot. But if you then break it down to weekly, it comes to only 2.5. And if you break 2.5 into daily, it becomes 0.5. So your target becomes only 0.5. So if your target is 0.5, what should be your risk per trade? It means that you can actually risk quarter per trade to be able to do that. Or half a percent. If you go with 1% risk, then really your target should be like 15-20%. But that means that with 1% risk per trade, your drawdown are going to be high as well. So I keep mine very strict. I never want to draw down more than 3% at any point in time, whether it's in a day or a week. And that's how equities, if you check with any proprietary firms, any trading firms, they put these strict risk management rules on their traders. They hate drawdowns, and the retail trader doesn't even know what is a drawdown. When they think about it, they only think a drawdown is when your account goes below zero. So if you're in profit, that means you have no drawdowns at all. That's totally wrong. There are loads of people who don't know this, but drawdown actually is it's basically something like so if your account was at this level and it went up there, that's the highest point, and then it started coming down, and it went up. So the distance, where's my arrow? The distance between this peak of your equity and the trough here, peak and crest, that's drawdown, even though overall it's profit. So let's say if this was 0, this is your 0 point, this is your 10%, you came down to 8%, then you went up to 15%. You're 15% in profit, but you still draw down 2% here. So if you start the day at 0 and you go to 2%, and then you come back to 1%, you've actually drawn down 50% on that day. So the rule is never draw down more than 50% at any given point. So for the day, if your target is 2% a day, you go to 2%. Now you can only allow yourself to come back to 1%. If you went down to 1%, you have to stop here.
Okay. Yeah.
And if your daily stop is 2%, you started at 0 here, and you went down to 2%, you stop. And the question would be, oh, couldn't we work our way up to 1% or 0 a bit? Yes, you can, but in attempt to do this, you could go down to -4%. That's the risk we cannot take. This management of risk is more important than learning how to trade. It really is.
So if you start the day with a drawdown, you just finish trading. You just pull out, don't do anything well.
You need to have everybody must have a daily stop loss. And if you hit your stop loss, the daily stop loss, you must stop. So in trading plan, you need to have, this is very important, account stop loss, usually 30%, yearly stop loss, which should be similar to account stop loss. Then you have monthly stop loss, 10%. So if you're targeting 10%, it makes sense that if you went down 10%, you should stop.
Yeah.
Then break that down to weekly. So your weekly, if you don't want to do 2 points, you can say 3%. 3% weekly stop loss. And that would then mean that you cannot be more than 3% down on a single day, because that's your weekly stop loss. So people get confused here. It's like, okay, if my weekly is 3%, shouldn't my daily be then 0.5% or 0.25%? That's not how it is. We still go with, say, 2% or 1.5%. 2% daily stop loss. So if you went 2% down today, Now you know that even if you win 1% tomorrow, your week's going to be down. So what do you do? Well, the way to do that is that if you have a, let's say, 3% weekly stop loss, and today you're down 2%, tomorrow you cannot trade with your normal lot size. So suppose today you were trading with 0.5% risk, and you took 4 trades that were losers and you hit 2%. 2% loss. Tomorrow when you come, you cannot trade with 0.5%. You're going to go with 0.25%. Because now you have 4 trades, and if those 4 were losers as well, then you would go down 1%. And so in doing so, 2 consecutive days of losses would have hit your weekly stop loss. If you come and trade the next day, you have 0% available. So that's why risking less per trade is the best. So mine is like, I would go with 0.5% mostly, or 0.25%, and 3 trades in a row lost is equal to stop. No more trades for that day. So that means that you have 3 strikes available. So if I traded here and it was a loss, and then I traded here, it was a loss, I'm not going to try again. I'm not going to try again in this wave. Then I would see this and I would be like kind of pissed. Thinking, I missed it, but that's fine. Then I'll wait. I'll wait for it to break. When it broke out, I have 1 strike available now, right? And if that strike was a winner, now I have 2 strikes available. I'm good now.
Yeah.
I'm going good. And then you build on the winners. So if I took this and I'm 2R up, and then I took another one, I'm 2R up, now I'm 4R up. Now I have the freedom to lose 2R and still be in profit. That gives me tremendous power to continue to trade, make more and more and more. So if I'm 6R up, now I have 3 hours available. Now I can choose. Now if I think that the market is very strong and probability is high, I can go 1%. Because I know that even if I lost 1%, I'd still be 4% up. So that it kind of goes. So what people would normally do is that when they lose, they raise their risk. And when they win, they either stop or they lower the risk. That's the wrong way of trading. That's the opposite. In trading, mostly, retail traders kind of think the opposite of what professional traders would do. Risk more when you're making money. Risk less when you're experiencing drawdown. Should be the other way around. So when the markets are moving strongly, trade as long as you're winning. But if you kind of like, even if you are trading, you're a beginner, you enter here, you exit there, you enter here, you exit there, you enter here, you exit there, you can still do that. Like, you can mess it up. Stop. If you entered here, you exited there, 1 mistake, you entered here, you exited there, 2nd mistake, just forget it. Stop. Something's wrong. So trading plan. That's why, keeping a journal and having a trading plan. The reason you keep a journal is to basically record your performance so that you can tally it or compare it with your trading plan. Keeping a journal actually is a way to ensure that you're following your trading plan. So people first, they never bothered creating a trading plan, if they do bother, it's very narrow, very shallow, not really detailed. It's not clear. It's a trading plan, sometimes copied from somebody else, just because they learned that they have to have a plan, so they just write it down. It's not theirs yet. And then the third mistake is that even if it's there, they don't keep a journal and they don't tally it, so it's useless. Keeping a trading plan is very important. Risk management is the most important thing, and you cannot do risk management without a proper trade plan. I don't know why we started talking, but that's what it is.
That was awesome. Thank you. Another question. How do you do your journal when you're trading 1 minute?
Oh yeah, that's a very good question. How do you do your journal if you're trading 1 minute? Because you might end up taking too many trades or something. Is that why?
Well, I guess because you're not kind of noting down at the time your feelings before you get in and the feelings after, because it's all happening so fast. So what's the best way to do it?
For the 1 minute, the methodology, even the discipline, the DS, the way we mark our trades. For me, what I do is that I have a discipline score for the session or the day. So you want to record all your trades and kind of call that session one trade. How did I perform today? You might have made a mistake or two, or you might not have, or you might have taken good trades. There has to be an element of profitability and an element of discipline, both at the same time. So when you start to make money, then your discipline score is supposed to be on both of them, profitability and discipline at the same time. Did I bend the rule which allowed me to become profitable? Was that a great decision? Did I bend the rule and that was a bad thing and that turned my profit into a loss? Did I trade correctly? Did I risk more when it was good to risk more? Did I risk less? Did I follow those rules? Or when I was in a drawdown, what did I do, and that kind of stuff? For the whole day, you can do that. So yeah, it could be cumbersome, like for a 12-second chart, to do that. So if you usually end up taking 4, 5, 7, 8, I've ended up taking 20 trades in a day. I haven't marked every trade separately. I've just taken an overall look of that day, and then I've called it a highly disciplined profitable day or not. A highly disciplined loss day, good. A moderate disciplined profitable day. A moderate disciplined loss day. A very bad disciplined profitable day, hardly ever going to happen. A very bad disciplined loss day will always, all the time, always, almost all the time will happen. So yeah, that day, so that way it works really nicely. You have 20 days, 20, 21, 22 days, and your batch becomes a monthly batch. So in a year you'll have 12 batches, and you will have numerous trades. And obviously there are multiple rules that you can use to kind of score your day. So suppose there are 5 elements that five factors for the day you look at, and you have checked 3 of them. So that's more than 50%. You can call that a moderately disciplined day. It's a DS1. You're in stage 3 or above. You know that you have bent a rule a bit today, but that is something that you sometimes do, and you have seen the evidence in your account that actually that turns out to be profitable in the long run. You know, that kind of. So it can be complex, or it could be very objective and clear for beginners to say, in a way that you have a solid plan, you have broken a rule, you have taken 3 trades, you've broken a rule on 2 trades, and 1 was correct. That's it. It's a discipline 0 day. So you have to, you can put it that way. Or if your trade plan is that you only take 3 trades a day, then you can just, give each trade its own value. And yes, day trading, you only want to trade 1 or 2 hours, not more than that. So for example, if you saw this, you traded this, in 3 minutes we were done. Stop there. Do your journal. What did you think? What happened? Blah, blah, blah. That's it. You've done your target. You don't need to trade this because you've traded that. But if you didn't trade that and then you traded this, then quickly do that. So within an hour, we should be done. Like you see today, we were done within an hour, and then I started talking. So here we are. Make sense?
Yeah, it does. Thank you. I've been very slack with my journal because when I started doing more trades, and I think you can tell because my account is reflecting how poorly I'm recording and analyzing everything.
Yeah, it's not easy, but once you get into the habit of it, then you won't feel great unless you've done it. Like it will be something that you would want to do.
That makes sense.
It's just a matter of habit, isn't it? Everything in life.
Indeed. Yes. Thanks, Emmy. That was awesome. As always.
Thank you. Thank you for asking the questions. And the time, honestly. Let me have a look at some few currencies. I think there was something going on Australian dollar. So currencies are different, work differently. The example of a pullback setup here, again, first this would not be my pullback because of this candle. You want pullback candles to appear after trend candles like this. So like if you went long here, you'd get out. Then this is not going to get you in. People would get it confused. And then they would consider this as a pullback. This is not a pullback for me because this failed. And before this failed, even this is not a strong bullish. And even before that, I'm thinking about this is actually a reaction to this. So this is the reaction. If it failed there, and then it failed again, I'm not going to go long here. If I do go long here, then obviously this is going to be my first target to see what happens there. There is some space. Otherwise, I'll wait for this to break. And this concept can then be translated into setup one. So if you do this analysis, let's put a line there, actually across, and then we go to the 4-hour chart. That same concept now would apply to this. So this is my peak, and we know that this peak was a reaction to some other peak to the left. There was a B trap here, and when you have a B trap, you will not take a trade unless the B trap is broken, or that the level that you're going to trade on the 4-hour chart, it's the same as the B trap. So it could happen that price comes to this level, then it goes sideways, creates a box, and we probably take a trade there. This was not a setup. Well, it was a setup, but this will be filtered because of the height of the box. The box is too big. Actually, the box is bigger than the boxes to the left. That's even worse. You want the box to be, you want the stepping down box. You know, just like we need nice and clean pullback candles, we need stepping back, stepping down. So for bulls, we need stepping down boxes. For bears, stepping up. This would have created a nice stepping down box in this area. Let's check it out on the hourly chart, 5th of November. See? So those were 3 candle pullback, and every candle high has created a box high. So this is a stepping down box. AO has not crossed the 0 line for this time frame. But for the hourly chart, this is a nice trade that would have started you right at Frankfurt Open. This is a good trade. I think it would be a nice setup on the 30-minute chart. Let's go there. There we go. 30-minute chart, you have a peak of 3, cross of 0 line. You go long right at the open. Right. And that's it. I think that's enough for the day. I shall see you tomorrow.